This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Melissa Lewis, joined by our experts Manus Clancy and special guest Joe McBride, who is filling in for Diane Crocker while she enjoys a well-deserved vacation. Joe is a senior director within CitusAMC's commercial real estate division, where he leads strategic growth initiatives across CRE valuation, servicing, asset management, and advisory solutions. Previously, he served as senior director and head of information solutions at Moody's Analytics, guiding development of advanced CRE data products. Before Moody's, he spent more than a decade at Trepp, most recently as head of CRE finance, where he oversaw product strategy, market research, and analytical model development. His insights have been featured in major publications, and he co-founded the wildly followed TreppWire podcast. Welcome, Joe. Thanks for being here with us today.
This is a great thrill for me. For those that know Joe and I and go back with us many years, you'll know that Joe and I did about 120 podcasts together in our previous life. We started in 2020, and we had a lot of laughs during that time. So while Diane Crocker is irreplaceable, I am really thrilled and honored to have Joe here, and hopefully we have as many laughs in the next 40 minutes as we did 6 years ago.
So before we even talk about Citus or the market or anything else, I just want to say that never fear, because when we had our first conversation together like this, it was during a time of epic uncertainty and market turmoil. It was in March or April of 2020. Little did we know, and maybe we had a tiny bit of an impact on it, that we were going to go on one of the most epic bull runs in commercial real estate for the next 2.5 years or so. So where are we now? At a time of epic turmoil, although the market's seemingly doing quite well, but a time of turmoil and uncertainty, maybe we can go on another 2 or 3 year run after this.
So you're saying there's a very tight correlation between you and I doing podcasts and market velocity and improvement and price appreciation and so forth past his prologue. Is that the prediction here?
I hope that this can be a salve for the market, and correlation and causation, tomato, right?
Well, if this is the case, if we see an explosive CRE rally, we may have to bring you back as a recurring guest. But let's get to the topic at hand. Let's just jump in. You've been at Citus now for a while. I think a lot of people don't know all that much about Citus and how far your tentacles go into the commercial real estate various segments. I like to joke with you that you're the biggest firm that nobody really completely understands. So give us the whole layout of Citus and what you guys do and what Citus' role is in the whole CRE conveyor belt.
Sure. So I'll try to keep it concise. When I first got here, my line internally, or even when I was talking to prospects or clients or friends in the industry, is that everybody knows Citus, but they usually only know them for the one thing that they know them for. And they don't realize that there's a bunch of other things that we do. Now, from the top down, CitusAMC is actually a combination of a few different businesses that have been acquired over the last 10 plus years. There's a residential side of the business, which we won't really talk about, but that is a big piece. But the commercial real estate side is really kind of 3 legs of a stool. One is servicing and asset management. So we do primary servicing for lenders, insurance lenders, non-bank lenders, for CMBS, CRE, CLOs, SASB deals, things like that. We also have a very seasoned and well-regarded special servicing group. We were, I think, the number 1 special servicer on SASB deals for the last couple of years, and we're also pretty heavy in the CRE, CLO space there. So that's the servicing and asset management side. Then we've got a very large valuation group. There was a firm called RERC, which was around for many, many, many years in the appraisal valuation world. That's the group that Citus acquired years ago. And so they do appraisal management, but also straight up appraisals and valuations, mostly for pension funds, Odyssey funds, private equity firms, and also banks that want us to help them manage their appraisal process. Within that, we have a debt valuation group as well, which we may talk a little bit about, Manus. It reminds me of our old days back in the bond pricing and the loan pricing world. But that's been growing quite a lot given all the non-bank lender activity that's been kind of sprouting up in the last 7, 8, 9 years. And lastly, the third leg of the stool is our advisory group. So that's kind of a kitchen sink group. We do, if you can think of it in commercial real estate, especially on the lending side, we probably do it. But, to break it down, it's loan sizing, underwriting, lease abstraction, portfolio reviews, due diligence, site inspections, all that kind of stuff. So I kind of feel like we're the boots on the ground to help get deals done. And on the kind of other side of the spectrum of that group is we actually build out teams and platforms for companies looking to scale up very quickly. So that a group may be, starting a CMBS shop or starting a new lending operation. They may not want to go right away and hire 15 people, but we can actually build the team for them, keep them on our balance sheet, and second them into those firms. So a lot of different stuff. A lot of people think of us as a servicer. A lot of people think of us as, that underwriting shop, but we're kind of everywhere.
Even I learned something about that, how deep your tentacles run. What really got me interested about what you were just talking about is how wide your purview is. You mentioned working with pension funds, private equity funds who do CRE, CLOs, the CMBS market with banks. Those are really the 4 pillars of commercial real estate lending, 5 if you throw in insurance companies as well. So all the pillars of CRE lending kind of come under your purview, and that should be a perfect segue into what you're seeing and what you're hearing at the cocktail party circuit when you're going to visit clients and so forth. So I do want to get into market conditions very quickly. I do want to take a very, very quick detour because in the old days, we would get tons of inbound emails, some of people we haven't heard from in a while. So if you're out there, Key Lime Johnny, the Yankee Clipper, Steel City Dave, Three Dog Night, we would love to hear from you because it's been a while since Joe and I have been in the cycle of hearing your insights. Deborah from Texas, all of you, if you have comments, even if they're snarky, come at us. In any event.
Don't forget Oz.
Oh, can't forget the all-powerful Oz, who's one of our earliest listeners. So let's get into the market itself. Early in the year, it seemed that CRE was setting up for a good year. Interest rates were inching lower. Liquidity was plentiful. Transaction velocity was rebounding. The office market seemed to have found a bottom. Problems in multifamily, either from syndicators or from anemic rent growth, were starting to level off. But we've been jolted a few times this year. We'd love to get your thoughts on a bunch of issues. Let's start with private equity credit, right? A couple of years ago, that was the big driver of new loan growth. And then we started seeing headlines late last year about maybe on the corporate loan side, discipline had kind of left the building. Has that impacted CRE? Has that impacted loan velocity, liquidity? Are people getting concerned that this might move over into the CRE side?
There are many, many opinions when you talk to people, but maybe if I just take a quick step back, and you talked about the beginning of the year and the feelings and things like that. I was on the circuit for the first couple of months of the year at MBA and CREFC and even more recently NACREF and a few, all over the place. And what kind of blew me away was, other than one conversation that I can remember at MBA, every other conversation I had was with banks or non-bank lenders that said, our targets are 30% higher this year or 40% higher, or we did $1 billion last year, we want to do $2 billion this year. And people, sometimes when you talk to originators or salespeople, they'll kind of scoff and be like, yeah, my targets are so high this year. This didn't feel that way. This felt like we're feeling good. The market looks good. We've got tons of capital ready to deploy. We're going to get it out the door. There was a little bit of a concern about, will there actually be enough, investment sale transactions to support all the debt capital that wants to be put to work? There's always a lot of refinance potential and activity, but you still do need that transaction world to come back. and that conveyor belt to get going faster. Now, fast forward to today, I'm kind of reminded of a few years ago, Mohammed El Arian. That's how you say his name, right? He was the keynote speaker at MBA out in San Diego. And it was during the time, it was like, maybe it was early 2023 or 2024 when we were really in the doldrums of commercial real estate. Transaction volume was down. Do you remember that one?
It was right around the time of the Silicon Valley Bank failure, which led to a blowout in spreads and a real pain upon pain. Not only was the CRE market limping, but then we got the shock, which was Silicon Valley Bank. But continue the story.
He kept using this phrase, and the way he said it was kind of funny, but he kept using it and saying, what's really important for all of you people in this room is the provision of information. He kept saying the provision of information. And his point was, he was talking about just in commercial real estate. He said, commercial real estate is a very, very amorphous and large term that incorporates 12 or 15 different asset classes and hundreds of different markets and all sorts of different investment strategies. So when you're in the room with a client or a potential investor or whomever you're selling to, make sure you explain the difference between you and a 1950s office building on 3rd Avenue, right? Because some people just see the headline in the Wall Street Journal and say, real estate bad, right? It's like, well, maybe some real estate is bad, but actually it's doing okay, and 85% of it is doing okay. So I actually sent that story around internally here at Situs when some of this private credit chaos started to unfold. I don't know if anyone really read my long opus that I sent around, but the point was commercial real estate debt funds, the assets on the debt fund's balance sheet are way different than the assets on, a BDC's balance sheet. We are secured by real physical property. We're secured by leases and bricks and sticks and everything else like that. So even if we do have distress, and there always is a certain percentage of distress, it's very easy to tell a pretty strong story about the underlying fundamentals on our side. And honestly, I think the BDC and the corporate stuff is completely overblown. It's a liquidity problem masquerading as a fundamentals problem. So the question is, can those private equity lenders or the private credit lenders, it's kind of the same thing, can they weather this kind of PR storm long enough to where they don't have to mark all their NAVs significantly down to do a fire sale and meet the liquidity requirements? So there's a lot of words all over the place, but the point is we have a really strong story in CRE, and I think we still do. And on our side at Situs, we're still talking to, like once a week at least, we're talking to somebody who's spinning up a new fund, a new debt fund in commercial real estate, a new bridge lending fund. I thought there's not enough properties in the whole world for the amount of bridge lending funds that exist out there. I think the CMA list earlier this year had like 270 or something. But these are smart people. These are not dummies, right? So they still see an opportunity in the space. They still see a pretty good risk-adjusted return. So maybe I'm a little bit Pollyanna-ish about it, but maybe we even benefit from some of this. Maybe the private debt allocation of large asset managers, large pension funds, whatever that allocation is, 5%, 10%, 20%, maybe they kind of adjust that a little bit more to the CRE or to the real estate side. So maybe we even benefit from this, in the longer term.
I'm a believer of that thesis that you just brought out, and we'll talk about that a little bit more as we go on the next 40 minutes or so. But you bring up a terrific point, and I think it's worth underscoring that on the CRE side, visibility, generally speaking, is quite good. It's terrific in the CMBS side. I think it's very, very good in the CRE CLO side. You know what the asset is. You know what the net operating income is. Maybe you have a little bit of opaqueness in terms of interest rate caps and the availability to extend loans and things like that, business plans. But by and large, I would say CMBS gets an A+ and CRE CLOs gets an A-. I think in the private equity corporate space, you get a D or an F. And I think that that's the problem right now. You have these loans you have no visibility into them at all. You just know that it's a loan to triple C plus rated software company, period. And you don't know exactly what is securitizing this or what their revenue is, what their revenue growth is, what other liens there are. So I think that the information flow is a huge point, and I think that CRE has to lean in on this. But just to make sure that I understood this correctly, is your point that at this time, people are not suffering from guilt by association, that PE firm on the corporate side, bad, therefore PE CRE lending must also be bad?
So far, we haven't really seen that. There are a couple of large firms that have been in the news a lot. So I think the folks inside of those firms, even on the real estate side, are, let's just say, affected by it. I don't think that their day-to-day kind of lending activity is necessarily affected by it, but more of like a, hey, what's going to happen in the long term here, more on the corporate level. That just affects people personally and things like that. But we don't see the guilt by association just yet. And I think, again, like, if you think about even the worst case scenario of a commercial real estate loan, I mean, let's not say that, because there are properties that have zero value or negative value in very weird instances. But usually the worst case scenario is the value of the collateral drops by 30, 40, even let's say 50%. And on a 60 or 70 LTV loan, okay, I take a little bit of a loss, right? And that sucks. But a software company, by the way, I don't really believe this whole concept of AI is going to kill all software companies. I'm actually on the opposite side of that. But if the perception, or maybe there is a scenario where there is a software company that's just, hey, this software doesn't make sense anymore in the new world. So like, what's the value of that company anymore? Right? Like there's nothing there. There's no asset there. There's no physical asset. They have intangible property, things like that. But is that worth anything anymore? So again, the volatility of the underlying collateral value is way higher, I would say, on the corporate side. Now the upside's way higher too, but the downside.
Somebody that is probably going to give you a couple of amen brothers to that part is old listener Shlomo, who has been a big believer in we have to rethink the way we look at CRE going forward. That is the tenant viable 5 years from now? Are they likely to renew? Is their business sustainable, or are they blockbuster video waiting to happen? So I look forward to getting his comments on your remarks. I'll close this segment on the PE with something I found interesting this week. JP Morgan came out with earnings. The earnings were strong. They had their investor call. Jamie Dimon got on for a couple of minutes. Last year, he talked about the fact that there were cockroaches in private equity, that if you see a couple of problems like we did with Tricolor and First Brands, there's probably 100 more. This week, he said, nothing to see here. Private equity, manageable. And he would know. He's got $50 billion in loans to PE warehouses. So if there's going to be problems there, he would know it. Were you surprised by his abrupt about face?
Not really. Jamie Dimon is just like the perfect CEO, in my opinion, because he's got that good balance of shoot from the hip and honesty and trustworthiness. But maybe the cockroach comment, he shot from the hip a little too quickly. And maybe he got a call from his warehouse repo lending desk and said, hey man, like we got 50 billion of this stuff. Maybe we should not call it cockroaches. By the way, my wife loves Jamie Dimon. She used to work at JP Morgan for a few years, and now she's at Morgan Stanley. So if anyone needs a job at Morgan Stanley, give me a call. If you're not taking losses, at least some small portion of losses, maybe you're not taking enough risk, right? Now, yeah, if you say, hey, if it's subprime mortgage category where it's, fraud, that's a different story, right? Now, Tricolor was fraud, double pledging assets or something like that. But like in general, if you take a few percentage points in losses on a multi-billion-dollar book, that's kind of par for the course, right? This is not a zero risk world or a zero risk investment. It's not like you're buying treasury bills. So it's okay as long as it doesn't become systemic.
We had Richard Hill on a few weeks ago.
By the way, that was one of my favorite interviews in a long time.
Thank you. That was great. And I like Richard Hill. I like his commentary on LinkedIn, very data driven. But he made a remark, and you said something very similar in our prep for this call, which was something to the effect that I trust the guys that have been through some cycles before, that make good decisions, have deep benches, are deeply analytical. You know, you know the names, right? People that have been around a long time. I'm a little bit leery of the two guys in a laptop and a new $500 million fund. And you made a similar remark yesterday. And I do think that that's where the rubber will hit the road. I think the savvy operators who've been around a long time, the Ares, the Apollos, especially if they're backed by capital that is patient, insurance company capital, they will come out of this probably better off. They will pick up market share and they will benefit from better pricing. It'll be the newbies that really struggle.
I have a bunch of other thoughts or like prognostications about what might happen here, but we have a lot of them are clients, so I don't really want to say too much more. But I will just say also that there is a difference between institutional capital and individual investor capital. And the firms that have more institutional long-term capital are a lot less susceptible to the momentary PR, negative headline, AI story stuff. But again, I mean, you and I, we've been in this data software game forever. And you know what it's like to try to sell a data set or a piece of software to a large enterprise. It's nearly impossible. And the hoops you have to jump through to get those things done and the amount of security and all that other stuff that you have to go through, it's very hard for me to believe that there's going to be this wave of guys in their basements with Claude supplanting Salesforce. Like, come on, right? So I have to think that the fear is a little overblown. Yes, we will see some casualties from this, but I think overall, the Salesforces and the ServiceNows and my old firm Moody's and those types of even Lightbox with appraisal management software, I feel like those firms will benefit more from AI than they'll be hurt by it.
I completely agree with that sentiment, and I do want to get more into that in a few moments. But before we do, let's talk about one more big item on the market condition side, and that is the war in Iran and its impact so far. So almost exactly a year ago, the market was shocked by the Trump tariffs. Stocks sold off, inflation fears surged, volatility spiked. CRE hardly missed a beat at that time. We saw no real slowdown in lending, no real slowdown in transaction velocity. CMBS last year, one of its best years ever in terms of new issuance. And now we're at a time where things are somewhat similar, but for a different reason. The war in Iran provided this year's unexpected jolt, oil prices leading to concerns about inflation. Stocks sold off to nearly correction territory 2 weeks ago. Has the CRE market, in your mind, been as stoic this time as it was a year ago?
Even more. Now, you did see a few deals here and there that were going to, coming to market to be priced that paused, as spreads blew out a little bit in week 1 or week 2 of the Iran war. But the activity continues apace, I would say. And I think spiritually, the market finally, and maybe it was early last year, or maybe it was late 2024, but I think it was in 2025, the market almost felt like they'd finally accepted interest rates where they were, right? They'd finally come around and said, you know what? Doesn't look like they're going to cut rates anytime soon. I've been holding this thing on my book for 2 more years than I should have. Let's start working through this. And I think that spiritual acceptance of interest rates as they were, it meant that when something like the tariffs hit or something like the Iran war hits, the thing you think about immediately is inflation. And if inflation is higher, interest rates are going to stay higher generally. But we had already expected interest rates to stay higher for longer. So everything we talked about in the beginning of 2026 earlier, where everyone was getting ready to go and double their volume, doesn't just all of a sudden stop, right? The ramp up has been going on for many months. And I think people are looking at this in the CRE market and thinking this is going to be contained. This is not going to go on for 6 months or a year, God willing. We will get back to kind of regularly scheduled programming somewhat soon. And we're just going to keep going, under that assumption. Now, let's hope that's the case.
I was a little bit surprised. I was surprised last year. I was surprised this year, maybe because in the past, and by in the past, I'm talking about maybe 10 years ago, you would hear stories of people retrading or walking away, that people would say, yes, that 5% loan that you had 2 weeks ago, sorry, I got to reprice this. It's 5.5 now. And the jolt was quick. We went and saw rates go from 395 on the 10-year to 445 very quickly. And risk premiums jumped out 25 to 50 basis points. So you were talking about 100 basis point jolt. And you're right, some deals did get paused, but there wasn't this race for the exits that we've seen in the past where people said, my lender's giving me a hard time. He's repricing. These guys are terrible. They're never reliable. It seems like a different world with tariffs and the Iran war. I'm not sure why it is, but it is.
I agree. I mean, honestly, I think it's what we learned during the tariff time, which is our president wants to do something right as spring comes around to kind of jolt the world and jolt the market. And usually he will backpedal if the market is deteriorating. I think he generally measures himself and his performance by the S&P 500. So when the S&P drops 10 or 15%, you expect some sort of backpedaling.
I'm going to go back to something you said before. We've talked about PE. We've talked about Iran. I think one of the real wild cards right now is AI. In tremendous enthusiasm last summer, early fall, about how this was going to revolutionize everybody. People could cut costs, improve margins, and so forth. Then we went into, I would call AI winter a little bit, where people were shocked at how much the CapEx was for the big tech firms, for Microsoft and Google and Amazon. And then we went into a second AI winter, which was, wow, this could wipe out Salesforce. I tend to be with you. You said this a few minutes ago, that maybe it won't be a headwind, maybe it won't be a tailwind, but it won't be a hurricane for these firms. I do believe that 2 guys and a laptop and a Claude subscription is not going to pass muster for a regulated bank that needs to have adults in the room, making sure data is not sneaking out into the public sphere, that the new software that's being written isn't susceptible to cyber attacks. If anything, I think this is an accelerator for some of these firms, that they're going to be able to say, we're going to take AI and make you more efficient than ever and provide you with the protections that you need to make sure that you're not subject to ransomware in 6 months.
Manus, maybe you and I are Luddites a little bit, but scale, distribution, and capital still often win, especially in the B2B world. They often win against even sometimes a better product, right? So even if you build the coolest, greatest, most efficient piece of software, there's that old adage, nobody ever got fired for buying from IBM. Like, nobody ever got fired for buying Salesforce to run their business. Nobody ever got fired for buying from Moody's or S&P or one, a brand name. So, and by the way, again, removing my humanity for a minute, a lot of these big firms will be able to get work done on the software development side with a lot fewer people. And so margin expansion, reinvestment of that expanded margin, maybe I'm just, like I said, maybe I'm a Luddite, or maybe I'm an old soul, but of course there will be some incredible advancements. There will be some companies that sprout up out of this, but I don't see the not the retail pocket, the SaaS-pocalypse. I don't see the SaaS-pocalypse coming anytime soon.
You can always count on Joe to come up with some kind of reference that our audience has to look up. What is a Luddite? And where did the term Luddite come from? And
weren't the Luddites the ones that were protesting against the cotton mill or something like that in London?
If I was on Hollywood Squares, I probably would have bluffed and I would have said it's something biblical from the time of David.
The textile industry in London was one of the biggest industries, and then all of a sudden they come up with this machine that can weave cotton or whatever into these textiles a lot faster than humans. And it was, for a lot of those weavers, it was the end of the world, and they were protesting, and they were the Luddites. So look at us.
Interesting.
I still want my Excel file that I'm manually updating. I still want to be able to go in there and change the assumptions. So maybe I'm a Luddite.
Well, I've never been a friend of the textile industry. As you know, I'm probably wearing rugby shirts from my high school days still. So it's the Luddites would not have been on my side.
Let's not talk about how old the undergarments are.
No, we won't go there. But I'm with you. I think what these companies will get and the way things will work is they will have two guys with a laptop and a Claude, and they will build a prototype, and they'll say, this will help us work a lot more efficiently. And then they're going to turn it over to Salesforce or IBM or some kind of supplier that runs their inventory management system. And they're going to say, build this under the auspices of all the checks and balances and guardrails you have in a way that's going to make us a lot more efficient. So the software companies stay, they become the trusted brand. No bank wants to be run off a GarageBand's software, but they have fewer people, margins expand, and at the end of the day, everybody benefits except perhaps the American workforce, right? You have fewer people finding jobs in that environment.
I tend to be pretty optimistic about the United States of America's economy and our ability to adapt. And in general, again, a person at the individual level, there will be stories of folks that are negatively impacted by this. But at the macro level, I do think this is going to be a massive boon, not boom, but boon to productivity. And if you increase productivity per capita, you're going to increase GDP, you're going to increase wealth, and you're going to increase quality of life across the spectrum. Now, we can get into data centers and the cost of energy and how much energy it's going to take to run all this stuff and that kind of thing. Even I look at Amazon, and again, going back, retail apocalypse, SaaS apocalypse, let's connect them. Everyone was saying the mall is dead, retail is dead for 15 or 20 years. And I saw this chart recently of the percentage of retail sales in the US that is done through e-commerce. And if you go back to 2000, the chart is a 45-degree angle straight upward until it hits about 20 to 22%. And it's been flat for the last several years. So there will be, I think that this AI stuff is going to be similar. Now, there might be a much bigger impact than just malls, but I think you're going to see a massive 45-degree angle of adoption and speed and businesses impacted and things like that. And then it's going to hit a plateau at some point because people still need to be people. People still need to talk to another human being, often to make a buying decision or a lending decision or any sort of important moment in a business's life usually requires a human being. So hopefully this just upskills people. It allows people that, maybe can only make a certain amount of money now, given their abilities. Maybe if you put this in their hands, they might be able to make 20 or 30 or 40% more. That's my optimistic take on all this.
I do agree 100%. You touched upon something which I think is important, but it's probably outside our level of really commenting smartly on this. I think a lot of this comes down to the cost of production, that yes, you'll get the benefit of a lower workforce, but you're seeing the numbers of CapEx that people are putting into this. At some point, somebody has to pay for this through the energy, through the investment, the return on investment on the data center acquisition. At some point, these tokens, I think, have to become more expensive and so forth. And then I think the balancing act comes in, which is how do you translate the benefit of the incremental AI improvement versus the cost that it's going to take? But I agree with you that there's going to be massive workflow productivity for the next decade, and we have no idea what's coming next.
And
I know we've been going a little long.
We've been talking too much about AI, but I would my last thing is the irony of it all is that AI is powering the office market in New York and San Francisco. So even the AI companies want their people back at work talking to each other.
That is ironic, and it has been a nice tailwind to see in New York and even more so in San Francisco. I do think that the life of the office worker is going to change dramatically, but I'm not sure I see companies going from having 1,000 workers to 10 workers in 2 years. I don't see that happening. I think they need a different kind of worker, but not, a 99% reduction in workforce. I know we're going long. We've had you for a long time, Joe, here. I do want to end up with two questions, really open-ended. What makes you optimistic for CRE for the rest of the year? What makes you think that all those lofty predictions in early 2026 might come true, and that bonuses will be big, people will meet their investment targets just in time for the holidays, spreads will come in, interest rates will fall? What keeps your juices flowing in April 2026?
Again, on the very macro scale, the equity markets and just the total wealth of the economy in the United States is off the charts. It's unprecedented. And my godforsaken millennial generation is still doing quite well in terms of income growth, net worth growth, things like that. And that's going to continue to power both multifamily and retail. Multifamily has been a massive area for commercial real estate for, basically since the GFC. I think it will continue to be that way because despite the fact that all the millennials I know have kids and own a house, that all the charts and graphs and economics people out there tell me that we're still all renting. But basically the demographic tailwinds I think are very strong for many areas of commercial real estate. And then you have on the other side of this coin, you have what you just said, this massive CapEx tailwind in AI, and it's almost a self-feeding process here. They've spent so much that they have to continue to spend so much to prove that it's still worth it and that they're going to get an ROI on this. So I think at least for another year, 2, 3 years, we're gonna keep seeing tens and hundreds of billions and even in the trillions flow into this more infrastructure space, data centers, even power plants behind the meter, things like that. And I think that is there's all these debates about, is that commercial real estate? Is it not? I don't really care. The same kind of people are working on that kind of stuff at the banks, at the debt funds, at the PE funds, and on the ground building the actual buildings. So I think that's just a massively large tailwind for commercial real estate in general. And those things have a positive ripple effect, I would say, in terms of dollars and money and capital to be deployed. So that, again, demographics, macroeconomic side is a big, strong tailwind. I don't foresee interest rates going up significantly. I mean, let's hope they come down a little bit. Personally, I think we should have a strong enough market that can support a 4% 10-year treasury and a 5.5% or 6% loan coupon. If we have properties that can support that level of coupon, I think that's pretty healthy. I don't think it's right to require 0% interest rates for commercial real estate to make sense. So still a lot to work through on the legacy side, but a lot less than there was a few years ago. And let me give you a couple quick numbers. I know I'm talking a lot today. Maybe I had too much coffee, but our originations group, our underwriting team, they did almost $30 billion in transactions in 2025, meaning they supported the underwriting, they supported the loan sizing, they supported the due diligence. That was a 44% uptick from 2024. And I don't have Q1 numbers right now, but I do know that Q1 was one of our best quarters of all time. So I have to think that we had a big year-over-year increase in Q1 as well. So even on the ground, you're just seeing the activity continue apace. And I'm optimistic, man. And I think the fact that we got together and did this podcast is kind of the icing on the cake that will launch us into the next year of growth.
That's right. The trigger. It's hard to find somebody who's more bullish right now on CRE than me. And I'm not usually one that drinks the juice, so to speak.
No, you're a glass half full, you're a glass half empty kind of guy most of the time.
I'm getting better at that. But, my thesis all hinges upon the war, right? And the war ending. And if we're still talking about this over the summer, then all bets are off. But I do think the moment the war is over, here's how I think it plays out. I think the PE credit concerns are enough that it forces the Fed's hands and they drop rates modestly to make sure that this doesn't become a bigger problem. CRE benefits from the slightly lower rates. CRE also benefits from the fact that capital is moving on the margins from PE credit to PE CRE or CRE in general. And the fact that we're starting to see offices rebound, that we're starting to see the drop in multifamily rents start to level off. I think all of that, the war ending being the critical piece, all of that triggers a just tremendous second half of 2026. I'll end with this. What worries you the most about CRE for the rest of the year and what keeps you up?
I don't even know if I have a good answer for that, Manus. What worries me is the black swan. It's not the black swan, but the thing that you didn't see coming, right? Because usually if something, really negative is going to happen, it's not something that the whole market is sitting around talking about and worrying about and foreseeing, right? So I don't know what that could be, if it's massive escalation in the Iran war or if there's, a much quicker disintegration of the globalized kind of trade economy or something like that. But I can't predict something that is that big or out of left field. But just on the ground, on a day-to-day, I'm not very scared right now. I'm sleeping. I guess I'm sleeping well, except for when my 5-year-old daughter wakes up at midnight and says she's ready to go downstairs and watch TV, which happened last night.
I guess you haven't trained her to put on the Bloomberg and that's Linda Amin.
Yes, go trade the Asia markets, Lucy.
That's terrific. I'm with you. I think, if we see $150 oil and that spike lasts past Memorial Day, that would be the black swan. I think everybody believes that the president has one eye on the S&P 500 and decisions will be made that prevent the market from going sideways. But a departure from that behavior, I think, would be that black swan that you are talking about. So with that, just appreciate Joe coming in. I hope some of our legacy listeners reach out to us, Three Dog Night and Steel City Dave, Yanni, of course, Yanni. And it's just been such a pleasure to have you back, Joe. We'll have Diane back in the saddle. We got to try to do this again before too long. It was a great 45 minutes of nostalgia catching up, and it's always great to talk to an optimist on CRE. So let me throw it back to you, Alyssa.
And with that, we'll close. Thank you to our producers at Bruning Media. Be sure to join us each week as we break down CRE news and data in context. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
For nostalgia's sake, Joe, why don't you send us out?
Let's go.